Very good evening, all. On behalf of NISM and India Bonds, I would like to take this opportunity to welcome you all for today's webinar, which is on bonds versus other asset classes. Myself, Amit Sayed, working with NISM. Along with we have today the renowned speaker from the industry who will be talking about today's webinar. We have Mr. Sunny Mirchandani, Director, India Bonds founding team. Along with him, we have Dr. Kapil Shrimal, Associate Professor, NISM. Let me allow you some brief introduction about the speaker before we start the session. Dr. Kapil Shrimal is Associate Professor at NISM, and he has worked more than 13 years under the academic section and 1 year in corporate. He has also started his career with ICICI Prudential LIC and worked with various institutes like PIMR Indore and Symbiosis University and Applied Science Indore. Also, he has done various assignments and major teaching areas with respect to financial planning, portfolio management, derivatives, financial modeling, financial management, etc. Dr. Shrimal received a Best Faculty Award by Dainik Bhaskar in the year 2012. He has done his PhD in Management Finance from Mohanlal Sukhandya University, Udaipur. Now talking about Mr. Sunny Mirchandani, he is a founding team member of India Bonds with over 18 years of experience in investment banking, debt capital markets, and real estate financing. He was earlier associated with Citigroup and AK Capital as a part of their investment banking team. Mr. Sunny holds a postgraduate degree in business management from NIMS Mumbai and a bachelor's in finance from Mumbai University, making him a well-rounded leader in financial technology and investment strategies. Before we start, so the major focus for the today's webinar, or let me convey what are the major areas which are going to cover for the today's webinar, where the speaker will be touching upon. Like when constructing an investment portfolio, it's important to understand how bonds compare to other asset classes. Each asset classes behaves differently and has unique characteristics, allowing investors to diversify their portfolios and manage risk according to their financial goals. Bonds are other less debt securities that represent a loan made by an investor to a borrower, typically government or corporation. In return for a loan, a borrower agrees to pay periodic interest known as a coupon and repay the principal as a future maturity date. Today we'll be going to learn about major aspects of this only. Let me convey to you that we'll be taking all the question and answer at the end of the webinar, requesting all the participants to put their queries in the Q&A board only. Our speakers will be happy to answer all your questions. So without taking any further time, I would like to hand over the webinar to our speakers. Over to you, sir.
Thank you so much for that wonderful introduction for Kapil sir and myself. I hope I'm audible to everybody. Before we get onto the presentation, first, I just want to say that what this presentation is going to answer, because a lot of you guys registering have raised questions. So hence, what are we going to cover is something I'll just give a quick brief. What basics of a bond is, Kapil sir will be explaining the same. How a bond can give you a regular cash flow, or what is the cash flow that you can expect when investing in a bond. Then how an asset class, the basic understanding of an asset class, which is bonds against an FD, gold, real estate, equity. We are not saying that any specific asset class is good or bad. Depending on the risk reward ratio and the age at which you are or the financial goal that you want to achieve, you can invest across various asset classes. So we'll be giving you that factual data, not to say that any asset class is good or bad, but more about factual information in terms of how this will be. What are the risks that are associated while investing in an asset in bonds is something that Kapilji will also be covering. And what are the returns that you can expect while investing across asset classes? Obviously, this is linked to market, but in bonds, when you invest, what is the return that you can expect? To make this more interactive, people who have attended our webinar, the previous webinar, which was a super success, thanks to all the audiences, we have tried to make this presentation a little more interactive. And to do that, we normally launch a small poll just to understand our audience better, so that Kapilji and me, we are able to deliver a better quality of presentation to you and help you understand the topic in a much better manner. So I'll just quickly raise my first poll. I would really request everybody to please participate in this poll. This really helps us understand our audiences, because it gets difficult to speak to each one of you all one-on-one. Hence, that is the reason why we do this poll. So the question is very simple. that other than equity, because we all know that equity is given one of the best returns, but other than equity, which of the other following asset classes has given a better return or which gives a better return comparatively? And then we look at the same from factual data perspective. So I request everybody who's there on the webinar, please do participate. I'll again repeat the question. Other than equity, which of the following asset classes have given better returns or given higher returns? This is what do you feel? Please, maybe some of you all would have invested at different times. Over a period of time, the returns changes in every asset class. So there's gold, there is fixed deposits, there's real estate, and then there is bonds. So we all know equity always gives very good returns. It's a risk reward ratio. But at the same point in time, other than that, whether you have invested or you feel, it can be a perception, does not mean that you have invested in them. Maybe somebody feels you have invested in gold, gives a better return, real estate gives a better return, bonds give, or FD gives. So I request everybody to please participate. We have over 90% participation. Some of you have not participated. Request you all to please do that. Um okay, I think we'll wait for another 10 seconds and then we'll end the poll. We have over 92% who have participated. Uh, excuse me. Okay, we'll end the poll. Just to read out the answer, 38% of the people feel that gold has given higher returns compared to any other asset class after equity. 3% only say FD. 33% say that real estate has given a higher return compared to bonds or any other asset classes after equity. And bonds, 26% have said that they have got returns higher than any other asset class after equity. So we'll just quickly look at some factual stats. This is based on factual data right from 2014 till now. On the right side, you'll be able to see we've done a little bit of comparison. The green index, that if you would have invested 100 rupees in 2014, considering that there is cyclical movements, there was COVID, that is the reason there can be loss of capital also. But then again, if you continue to remain invested, that would have gone up. A Sensex would have given you 100 rupees would have become almost 300 plus, which you can see. The next best asset class that returns or consistent returns that we've got from 2014 till now is to surprising to the audiences would be a CRISIL AAA bond index. That means if this is data which is coming from CRISIL AAA CRISIL website, not that it is any information that we have published. This is based on the facts. The sources also mentioned. The next best is which 33% of the people also said, or 38%, sorry, is gold. Post that is real estate, and then the FDs. So for FDs, yes, you were right. Because the return risk reward ratio over there is being a bank FD, it's more considered as more safer because of the DIGC insurance. So the returns are a little low. But just for everybody's information, bond index, even though gives a consistent return, over a period of 10 years has given a much higher return compared to any other asset class after equity. Right. Over to you, Kapilji, from here, just to bust some myths, and over to you if you can guide
Yes.
our audiences a little bit and help them understand a little bit better about bonds as an asset class.
Thank you, Saniji. So first of all, as a part of the poll that we have seen, most of the people are thinking that the a part of the equity, other asset class like the gold or the real estate is giving a return. It can be vary, but yes, bond is one of a part where you can see if the risk-free bond or AAA rate bond is there, that will give the better return to you for the future. Now, what bond is, so that as a part of the basic understanding of a bond, quickly we'll go what the bonds are. The bonds is an instrument or the financial instrument which the company will borrow, okay, from the market. Like it's a part of the debt instrument for the company. So company will take a loan from the retail investors or the institutional investors. This loan is known as the bonds, issuance of the bonds or the debentures are done. And that loan is a part where the company will say, whatever amount company is going to raise from you, on that amount, company is going to give you the fixed return. That fixed returns are the coupon or the interest in simple terminology that we say the company will give the periodic interest or coupon to you. Now, when this bond is issued into the market, The best part is of the bond is that at the day one, the face value of a bond will be, let's say 100,000, 10,000 or 1 lakh rupees. The return, what is the return that company is going to give me, that money back cash flow will be there to me. So here the example is there where the company is a borrower or the issuer is a company where the face value of a bond is 1 lakh rupees with the example. The interest rate is 10% per annum. Now, interest rate is 10% per annum. It means if you invested in the bond of 1 lakh rupees, the company is going to give you 10% of 1 lakh rupees either per annum if the bond coupon is annual frequency, or 6 monthly or quarterly, that depending upon the frequency. So 10,000 rupees either per annum or 5,000 rupees will be divided into 2 parts, or 2,500 into 4 parts. So this frequency will be there. So this frequency will give an idea to you that how this bond is going to give me the annual returns or monthly returns to me. Number 3 part is that when the bond is issued into the market, the compulsory bond has to take, or the company has to take the rating from the rating agencies like the CARE, ICRA, CRISIL, Fitch, or something like that. This rating will give an idea to the investor whether this bond is investment graded bond or non-investment graded bond. So what are the investment graded bond? Any bond which is rated triple B minus, below triple B minus, that is, they are the junk bond. So on that junk bond, you should not invest. But if the bond is higher rated, if the AA, AAA rated bonds are there, in that case, that bond is the secure bond. It means the company is having the capability to pay the investors money back in future at the time of redemption. Now, when the bond will be issued into the market, the redemption will be can be for the 3 years, 5 years, 10 years, 15 years, 20 years, or in Indian government, India bond can be maximum to 40 years redemption can be there, or perpetual bond can also be there. So at the time of the investment into the bond, you have an idea that this will be the maturity date or the redemption date to me. I invested 1 lakh rupees into the bond. The bond is going to give me, the company is going to give me 1 lakh rupees back after 10 years. If the maturity date is 10 years from the issue. So that is one of the surety will be there. And yes, most important part that as per the companies, as per the company, the investor should have all the documents to be as a part of the due diligence, or as a part of the what we can say transparency. All the documents will be provided to the investors, because these bonds are going to be listed and regulated by the SEBI into the market. So this is the basic idea about the bond. So bond is what? If an investor want to invest into the fixed income security where the risk is lesser as compared to the equity or other asset classes, the investor will issue into the bond. These bonds can be issued by the company directly into the market, or into the secondary market also you can do. So this is the basic idea about the bond is there. Now, Sanij, can we go to the next slide? Yes. So now this is an idea that how this cash flow of a bond will be worked. So the example is that, let's take an example. Initially, you invested 10,000 rupees in a bond, where bond is going to give you the 10% coupon per annum for next 5 years. So maturity date is 5 years. It is saying that the company name is ABC Limited. Maturity is the 5 years. 10,000 rupees is the face value of a bond. And this is a basic data. Now, what happens at the end of each year, till the 5th year, company is going to give you the cash flow of 1,000 rupees is a coupon. That coupon is the interest you're going to receive from that particular bond. And at the end of the 5th year, the coupon plus the principal amount that you paid, that is 11,000. So that will be the 11,000 rupees you'll receive at the end of the maturity. So in total, you will receive the 15,000 rupees by making an investment of 10,000 rupees, considering that bond is giving you the 10% coupon per annum, and you invested into that particular bond for next 5 years. The best part is that you have the assured cash flow over the period of time, and you can plan something for your upcoming cash outflows will be there, because you have the cash inflows every year going to be provided to you. And if you have this particular calculation, you have the again idea that in the future, whatever amount I invested, that amount is going to be received at the time of the maturity to me. So that will give the good returns as a part of secured investment to me. So this is basic the cash flow cycle of a bond investment is there. It might be possible the yield of a bond, because we are going to discuss in yield about in the upcoming sessions also. But yield of a bond can vary. That is totally depending upon the market returns is there. So what is the maturity? What is the current coupon rate? What is the issue date? What is the buying price, something like that, redemption price is there. Based on that, the yield calculation will be done. But yes, if you have invested into the bond, you have an idea that every year you're going to receive 1,000 rupees till the maturity, and at the end of maturity, you're going to receive your principal amount back. So if you invested 10,000 rupees till the end of the year, you're going to receive 15,000 rupees till the maturity held of that particular bond. So this is a very basic, simple example of the cash flows of the bonds is there into the market. Yes.
Very similar to probably how an FD would work in terms of when you do an FD. Very similar to that.
Yes.
Is that fair to say?
So no, it is not similar to FD, because FD will not give the frequency of the what we can say, the cash flow to you, in coupon to you. If you are
Right.
if you are going to do the FD will say the amount will be invested today, and it will be going to receive at the end of
On
the
maturity.
at the end of the maturity will be there.
Understood.
But yes, there are certain FDs available into the market. Those who are going to give you the coupon back, quarterly or half-yearly coupon interest payment is there. That can be one of the part. But that FD will give
Majority
the
is
return as
towards on
simple.
redemption.
Yes, the maturity is lesser and redemption is
Understood. Okay. So, Kapil sir, before we move on to the next page, just wanted to launch a small poll just to understand our audiences better, that which is their current preferred asset class for investments. Like the audiences who are today there, we've got an overwhelming response while registration and today in terms of attendees also. So we are happy. It'll just help us, which is your preferred asset class, and it just helps us understand you as an audience better, why you want to learn a little bit about bonds as an asset class, and what is the reason that you should know about this asset class. So the options are the same that we are going to compare, which is the FD, gold, real estate, equity, or bonds. So I request everybody to please do participate in this poll. We have like 70% participation. I request all the others also to please participate. I'll repeat the question, which is which of the following is your preferred asset class? Which is basically FD, gold, real estate, equity, or bonds. We'll wait for another 10 seconds, Kapilji, and then we'll end the poll because still a lot of people are still participating. I see a lot of response coming in live. Once it slows down or stops, then I'll probably end this. I request everybody to please do participate. We are almost at 89%. I request more people to do participate in this. This just helps us understand our audience better and try and give a better feedback in terms of for the presentation for the asset class as a whole. Okay, should I end the poll? I think yes, there are still people who are participating, but I think we have limited time, so we'll have to end the poll now. Kapilji, would you want to take up the percentages or just let the audience know which is the majority?
No, percentage I'm not able to.
Acha, okay. Sorry, I'll just read out. I'm sorry. Maybe I have the that access. So 65% of the people have said that they prefer to invest in equity as an asset class. Around 14% of the people prefer bonds. 5% say real estate, 10% say gold, and 6% are saying FDs. Surprisingly, FDs are higher compared to real estate, whereas real estate perception was the previous question was that real estate has better returns. So I hope audiences, the reason why I'm sharing is it just helps understand, you guys also understand okay, what is the audience is thinking along with you, right? Okay, over to you, Kapilji.
Yes, yes. So thank you. So as per the if the most of the investors will think to invest into the equity, that is a good part. But if you are investing, truly investing into equity, then that is a good. But if you're trading into the equity, there can be the challenge for you. You can read the research report released by the SEBI in last 2 years. You'll find that how the traders are losing their money into the market. So that will discuss as a part of the equity will be there. But I'm going to discuss about the comparison of the FD with the bonds over here. Now, what is the FD or the fixed deposit is there? So that is a traditional form of investment, because why our fathers or forefathers or parents or us also are doing the FD into the market. Number one part is that is easy to do. Easy to do, it means we can go to the bank branch. Bank branch can be near to our home, or the bank representative will be come on call to us. and the applications base also there. Nowadays the FD is there. So that is traditional investment method. Number two, the FD can give the fixed return to you into the market. Nowadays, since the interest rate has increased in Indian market, so nowadays the FD rates are near to 7% or 7.5% somewhere. Okay, but in between it was 6% also. So fixed returns are there. Number two, it is similar, like very familiar or easy application process is there. So if you are doing a FD investment through mobile application, so no need to fill the form, nothing is there. Only you to click on the FD part, select the tenure, and the FD will be done. And it is very convenient, that we can say. But when we compare the FD with the bank deposits or the this bonds is there. So a simple two parts is there. The bonds are regulated by the SEBI and the FDs are regulated by the Reserve Bank of India. Now, anything which is regulated by SEBI, it means it should be listed into the market. You can trade into the secondary market, especially for the liquidity. But for the FD, you cannot trade into the secondary market. The liquidity will be the challenge for you. You have to go to the bank. You can ask the bank to close your FD. The bank might charge certain penalty on the closing of the FD will be that depending upon the bank to bank. Number two, the returns bonds are there, that the bonds will give you the coupon rate, that defined coupon rate 6%, 7%, 10%, 11%, 12%, depending upon the bond to bond. And the possibility of the capital gain or loss will be there into the market link, because this is traded into the market, that depending upon the bid and ask, that depending upon the demand and supply liquidity, the bond is traded into the secondary market. And it might be possible at some point of time, if the bond price is more into the market, you purchase a bond at 950 rupees, for example, and bond at the time of selling, if bond is selling 1120 rupees, so you will get the capital gain also on the investment of your bond. But in the FD, the returns are fixed. There is no chance of FD capital gain or capital loss will be there, but the coupon or the returns is fixed. That is the part. Safety, again, the secured backed by the assets. The bond can be secured bond can be unsecured bond, but in Indian market, most of the bonds are listed and traded secured. It is regulated by the SEBI. The FD can be the security or unsecurity. When you compare about the FD, the best example is that if I done the FD of 50 lakh rupees in any of the bank, okay, and bank suddenly become default, in that case, the guarantor, that is a DIGCC, that is insured by the Reserve Bank of India, will give the maximum 5 lakh rupees is insured for me. So 45 lakh rupees loss can be I have to bear. And corporate FD are generally unsecured, so no insurance coverage on the corporate FD. Bank FD is covered up to 5 lakh rupees insurance to you. And that is a challenge. You can see in the past also some of the banks become default in Indian market, and the persons have invested into the FD or the deposit, their money is stuck, and still they are roaming here and there. Okay, now the lock-in period or the liquidity. So there is no lock-in period or in the this particular bonds or NCDs, but yes, on FD there is a fixed maturity or the lock-in period is there. It can be tradable. Bonds are tradable into the market. Okay, partially sell the bonds, units allowed. So yes, if you have the 10 bonds with you, you can sell one bond, two bond, that depending upon the money you require. But if you premature, if you ask bank to foreclose your FD, the penalty can be charged and the charges will be applied on that. The interest payout on this bond can be the monthly, quarterly, semi-annually, or the annually, or the cumulative interest will be there. Same thing with the FD, the same type of composition can be there. Yes, so the possibility of the loan or collateral are available in the both the cases. You can take a collateral loan on the bonds also. You can take the collateral loan of the on the FDs also. When it's compared about the taxation part, the long-term capital gain on the FD, if you earn the capital gain, if you hold that particular bond for more than a year, the long-term capital gain is 12.5%. And TDS will charge by the issuer at the time of paying the coupon to you at 10% TDS is applicable. Interest is taxable as per the tax slab over there. But when you compare to the FD, there is no possibility of capital gain. So there is no long-term capital gain is there. Yes, TDS, 10% TDS will be deducted by the bank, and the interest is taxable. If you earn that interest more than 15,000 rupees in one financial year on that particular deposit, the interest will be taxable as per your tax slab will be there. Inflation's
Yes.
real value of return is comparatively high, and in the inflation part, FD can be negligible. Because I'm just giving a simple example to you. If I'm investing into the bond where bond is giving me the 10% coupon every year, and over the period of time, the money, the actual return or the yield is more as per compared to the inflation. But if I do the FD with the bank where FD is itself is giving me the 6 or 6.5% return, where at the end of the maturity, if I'm coming into 30% bracket on that return, 30% tax will I have to pay. So 6 3s are 24. So actual return getting less than 4% or approximately 4%, which is much lesser than the inflation is there. So inflation is one of the biggest challenge when you do the FD in the banks. And again, the security part is there. But as compared to the return part, as compared to the liquidity part, as compared to the long-term holding, definitely the bond is one of the best options compared to the fixed deposit. Sanij, anything you want to add in this part?
Yes, like rightfully explained by Kapilji, we are not tax experts. This is to the best of our knowledge. It's best that you take advice from a chartered accountant for taxation. A lot of you have raised queries on taxation. Like Kapilji rightfully said, capital gain after 1 year, very similar to equity. If you sell it at a capital gain, you get taxed at 12.5%. 10% TDS is applicable on all listed bonds, and interest rate, whether you hold it to maturity or when the interest is paid on quarterly or monthly basis, will be taxed as per your tax slabs. So because whilst Kapil sir is explaining, I have also responded to a few of y'all who have raised this query, that what is the taxation. Hence, we have tried to cover that also. Like sir rightfully said, the best part is that some of you have asked in FDs, there is a premature withdrawal charges or there's a penalty that is applicable,
Yes.
which in bonds is not a penalty in case if the price, it can change. It's a market driven activity. It's a listed instrument. So if you bought a bond say at par, which is 100 rupees, there can be a possibility that you can sell the bond later even at a capital gain, which is at a profit of 102 rupees, or there can also be a loss, which where it can come down to any price like 98, 97, 95. That is also possible. You can set it off against your other gains versus, but that is something that you should speak to your CA, who will be able to guide you. But again, normally bonds are more an instrument where investors prefer to hold it to maturity unless until you're a trader. And if you're holding to maturity, then you will be charged as per your tax slabs, right? Okay, we'll move ahead, Kapilji.
Yes, yes, please.
Okay. So, next, a lot of you did say that real estate is one of your preferred asset class as an investment. I personally also come from background other than investment banking, where I was managing real estate financing. So it's definitely close to my heart as well. Roti, kapda और मकान सब बोलते हैं. So why do we all want to buy real estate? One of the reasons is safety, and for your family, not just physical safety, but it helps you, it gives you some kind of sense of security, which is more like an emotional attachment. It gives you that basic requirement that कहीं पे भी घूम के आए वापस तो घर ही आना है. So definitely real estate as an asset class is an important asset class. Again, the whole idea of this webinar is, which Kapilji and me, we are taking, is not to say that any asset class is good, bad, or ugly. We need to understand at what stage of your life you are. We are not advisors, but we can tell you that whenever you want to make any investment, whenever you want to buy an asset, it's important for you to know. And bonds have become so accessible. However, the knowledge around that, okay, whether it is available, what needs to look at, that is not available. And that is the reason why we are doing this educational webinar. Not to downplay or say anything wrong about any asset class. So coming back to equity. Now, bonds, like Kapilji said, is regulated by SEBI, provided these are listed bonds, only then they come under SEBI. Any unlisted bond, if you are investing, you cannot approach any regulator because that's an unregulated instrument. So I would request you all to please Whenever you're making an investment, please be aware. Eventually, buyer be aware is very, very important. Whenever you invest in real estate, also, they have a new regulator which is coming, which is RERA. This is to protect the investor. What are the returns that you would normally expect in a bond? We will show you the exact returns across rating classes, but on an average, you can expect a medium to high returns. Like a AAA bond would give you a relatively lower return. A GSEC would give you like a 6.75 to 7% kind of a return. GSEC is government securities. And a AAA would give you anywhere between an 8 to 9%, depending the 8%, 7.5 to 8%. The lower you go in terms of credit rating, the higher the risk you take, the higher the returns also you can expect. On the real estate side, in case if you invest in a residential asset wherein if you rent it out, I am not comparing this as an investment from your self-consumption. Please do not mistake your self-consumption property as an investment. We are only talking about an investment asset class. So if you bought a residential asset which you give on rent, what is the return that you can expect? Something like a 2.5 to 3%. At least that is what is the average return. Some may give you like a 3.5%, but in residential, we don't see a return which is higher. How do we calculate this? Very simple. 1 करोड़ का आपने अगर प्रॉपर्टी खरीदा है, उसके सामने आपको साल में कितना रिटर्न मिल रहा है इन टर्म्स ऑफ रेंटल इनकम, माइनसिंग the maintenance that you have to pay or property tax that you have to pay. That is your return. So if you have invested 1 crore and in the whole year you have got a return of 3.6 lakh rupees, you reduce your outgoing or maintenances, your net income say is approximately 3 lakhs. So you have to divide your 3 lakhs with 1 crore. That gives you a rental income return. The same thing works for a commercial and office space, which can be 5.5, going up to not just 6.5. Sometimes you may get a 7.5 also, but then you run the risk of the tenant. It can be the tenure of the tenancy. He can the maintenance cost, the interior cost. If you need to maintain, AC gets spoiled, anything of that sort. So all those things you need to keep in mind. What is the cost of acquisition when you're investing in bonds? So there is a very nominal stamp duty cost that is applicable on secondary bond transactions. Primary, there is none. In case if you would have invested in SGB or you would have invested in a public issue of debenture and bonds, then in that case it would have been 0.001. Just ensure whenever you're investing in these bonds, that is also there. It is actually the responsibility of the OBPP to ensure that they collect this, the exchanges collect this and deposit it on your behalf. Real estate, we all know that stamp duty and registration charges, plus in case if it's an under construction project, then there can be GST. This is one of the biggest pain points in real estate is the acquisition cost of the property is 12%. Today, when you pay this, and it can be as low as 5-6% also. If it's an OC property, then no GST is applicable. But whenever you sell this, again, you don't get any benefit. The next person who's buying it again needs to pay that stamp duty. Hence, it becomes a little more expensive and a little relatively less liquid as an asset class. What is the investment size in bonds that you can make? Thanks to SEBI's initiative and a lot of effort by the infrastructure providers like the exchanges or depositories and OBBPs also, and with a lot of support from NISM in terms of education awareness, the investment size for bonds is gone to as low as 10,000 rupees. And in public issue, it was only there earlier. Now in secondary bonds also, SEBI has allowed to get the face value or the minimum investment down to as low as 10,000 rupees. So all of you who would like to test, I would say first start, only make an investment once you are convinced in the most safest, secured investment asset class in terms of credit rating, and only start with as small as 10,000 rupees. In real estate, unfortunately, if you are buying a physical real estate, then in that case, it will be a little relatively higher. It varies or changes from city to city. The maintenance charges, like I said, for real estate, we all know house tax hota hai, maintenance hota hai, electricities, various things are there. It's relatively a little higher compared to your demat account charges. Whenever you want to make an investment in listed bonds, ensure that you use your existing demat account. You don't need to open a new demat account, and whatever is the annual charges that your demat account holder, your existing broker charges you. So there's no new demat account that you need to open for this. You can use your existing equity demat account. A lot of you, 60% plus people said you'll invest in equity. Please use the same demat account while making your investments wherever you do so. You don't need to open a new demat account. At least I can talk that for us as a online platform, we don't ask the investors to maintain multiple demat accounts. Liquidity, bonds and NCDs is something which can be high to medium. I wouldn't say it's just high. It is high, medium. Some can be low. The lower you go in your credit rating, the higher risk you take, the lesser the liquidity will be. So if you invest in a AAA bond or a GSEC, government securities, if you're a new investor, you should always start with the safest available possible bond or government securities where the liquidity is higher. In case if you need liquidity, you can definitely go and sell. Sometimes there are possibility that some bonds will have very low liquidity, almost negligible. Does not change the fact that everything is liquid. Unlike equity, bond market is still developing. Liquidity is limited. However, whenever you invest through somebody, they should help you or assist you at least on best effort basis to help you get the liquidity as well. So the good part is there's no lock-in. In case if you want to sell, it's tradable, so you can sell it through any broker. You don't need to only sell it to the person who bought it, because otherwise you will feel that you have to, if you bought through somebody, you have to sell through the same person. Absolutely not. You can sell it through any other broker as well. So that is one. Real estate, it's relatively a little more time consuming, more title due diligence, higher ticket sizes that you need to do. And when you want to sell also, it takes a little bit of effort. You need to get local brokers involved. So it's a relatively higher time cycle to liquidate that asset. Unless until it's a very hot prime property that you bought, but then in that case, capital appreciation can also be limited. Safety. Whenever you do a trade, kindly ensure whenever you invest in a bond, the bond has to be settled through an exchange, which is either through ICCL, which is the clearing corporation, subsidiary of BSE, or through NCL, which is a subsidiary of NSC. Either of the two you should use whenever you invest in any bond through any OBPP. He will ensure that the payment or the settlement only happens through the clearing corporation. It ensures that you do not transfer your bonds to any third party, or you do not transfer your money to any third party. You don't need to give the money to anybody or any broker. The money through payment gateways, or you can make a direct transfer to the clearing corporation, and they will ensure that they settle your trade. In case if for any chance the trade gets cancelled or it gets stuck, at least your money is safe, or your bonds are safe, and you'll get the money back from the exchange without any third party getting access to your capital. And in real estate, we all know that if you're buying a physical asset, you have to transfer the money in the direct party settlements. If tomorrow there is a litigation or any deal goes down, then that money gets stuck and then you have to go to the courtroom. So here in this case, in clearing corporations, if the deal is not settled, you will get your money back. Uh, Anything that Kapilji you would like to add on to this?
No, that is true, and especially as a part of the real estate, there can be the chances of the frauds can be there into the market. That is that thing you have to take care. If the RERA project approved project is not there, that can be there. Liquidity is the biggest challenge in the real estate, and definitely in some of the cities the capital appreciation can be high, but in some of the cities that capital appreciation can be low. So actual yield, that actual return that you're going to receive on real estate can be lesser as compared to the fixed income security into the market.
Right.
And if the rental incomes, just I'm giving best example as a part of the real estate only. If you are residing into the, or if you have the flat in, let's take an example in Mumbai, where you purchase that flat at 1.5 CR, the 2 BHK flat is there, and if you put that flat on rent, where you're receiving the 30,000 rupees per annum per month as a rent on that particular flat. So what is the return of investing 1.5 crore into 30,000? Out of the 30,000, 10,000 rupees will be the monthly maintenance. At the end of the year, if you do the denting and painting also, the actual return or actual money that you're going to receive every month is less than 10,000 might be possible. So that thing you have to make sure while investing as a part of the real estate. That is a challenge. and other charges will be there. There is again one more challenge in the real estate, that cash is one of the biggest transaction in the real estate will be there, that you have to manage. That is the biggest challenge in the real estate also.
True, absolutely. Next, gold. A lot of us love gold. Indians, myself, my family, we all love to invest in gold because it is limited and it is a good hedge against inflation. It's highly liquid whenever we want to invest in physical gold, and it's considered as one of the most safe havens. At one point in time, even the economy was, or the currencies were pegged to gold. Hence, we all love gold, and we all have at least emotional attachment when it comes to jewelry. So that is one of the reasons why, as us as Indians, we love to invest in gold, and we are probably one of the second largest gold consumers in the world, or maybe first. I don't know, not an expert, but at least that is what, to the best of my knowledge, is there. But to bridge that gap, there were certain aspects with reference to physical gold, which was probably something that government was trying to help our investor or the audiences to invest. Hence, they came up with a concept which was sovereign gold bonds. So before we go on to this page, some of you have asked this question in the query: what is the difference between an NCD or a debenture and a bond? A bond is normally issued by a government sector organization, versus bond, NCD is issued by a private sector corporate or a private limited company. There is not much of difference. It's just the type of issuer. So if a government entity issues, it's called a bond, versus a private entity when it issues, it's called a debenture or an NCD. Coming back to what SGB and physical gold, right? So sovereign gold bonds was issued by RBI. So hence he's the regulator. It's issued by the government rather, and RBI regulates the same. Liquidity, it is tradable on the stock exchange, very similar to bonds. So sovereign gold bonds. Whereas physically, whenever you want to do, again, the liquidity is high and it can be tradable with local traders and jewelries. What is the returns that you get in a physical gold? Normally, the capital appreciation is the only return that you get. Today, the gold prices have shot up compared to what it was probably 2, 3 years back or pre-COVID. But the only appreciation that you get is capital appreciation. Whereas a sovereign gold bond, you will get the capital appreciation. Let's assume you would have bought the first sovereign gold bond at 35,000 and it matured in 8 years. You would get the same capital appreciation at the end of the tenure. Plus, additionally, you have got a 2.5% return on the sovereign gold bond, which is paid to you by sovereign, that is by paid by the government. So if you've held it for 8 years, just imagine you've got a 20% appreciation or 20% interest over a period of 8 years if you hold it to maturity, plus the capital appreciation. So 20% gain, so you're anyway just standing on it, unless until the gold price goes up and down. But that's the same thing that will happen in physical gold as well, right? Maintenance wise, it is free from any maintenance. Again, in this case, when I'm saying free, we mean because it's in demat form, it is minimalistic. Hence, you don't have to maintain it separately physically. However, you will have demat account charges which you have to pay. Involves storage, making charges. When it comes to physical gold, there can be GSTs. There are leakages in terms of the quality of asset also. Whereas in sovereign gold bond, you don't run that risk, right? And whenever you want to sell, you have the liquidity that you can sell it on the exchange, right? What are the risks associated? Every asset class has some risk. I don't think so anywhere on this planet Earth, there is an asset class without any risk. There is no risk-free asset class, right? Every asset class will have some risk. It can be less, more, anything of that sort. But lowest risk is probably a government security, or it's a risk-free return that they call it in economics. That is the closest. Other than that, any asset class will have a risk because sovereign gold bonds, the interest will be paid by the government. But at the time of maturity, you run the risk. If tomorrow the gold price crashes, then you will get it at that point in time at the time of maturity. If it goes up, you'll get capital gain, right? So price fluctuation will be there, and it's the most purest form. In physical, you run multiple risks: price fluctuation, theft, wear and tear, the purity. Compared to that, SGB is relatively less riskier. Taxations. Again, we are not tax experts. Please, sorry if we are not able to answer any questions on that. We are trying to cover some aspects of it. But yes, if you hold this SGB till the time of maturity, and if there is a capital gain, that means if you are invested at 50,000, at the time of maturity is 80,000, the 30,000 rupees that you've earned on each investment, on your investment, is completely exempted by the government. Hence, uh, it's taxation wise more tax efficient as an asset class. There is no TDS applicable on the bonds. Provided, please ensure that you have invested in this in the primary segment. Secondary, if you have bought something in the secondary market or through the exchange, please speak to your chartered accountant. He will give you a better advice as to what is applicable, what is not. This is for primary investment only. When government comes up with a primary issue, at that point in time. On the physical gold side, long-term capital gain is applicable after 3 years, unlike normal bonds, which is after 1 year, and short-term capital gain is applicable till 3 years. What is the investment size? In gold, you can make physical gold, you can invest as low as 1 gram. The same way in SGB also, you could have invested in the primary segment as low as 1 gram, maximum up to 4 kgs. And whenever you make an investment online or through an RBI retail direct portal, you get a 50 rupees discount. Whereas in physical, there is no discount per se. Or if you buy through any of your brokers, through an online bond platform, through your banks, if you do an online investment in the primary, you get a 50 rupees discount on per gram, which is not available in physical as well. Kapilji, would you like to add something to this?
No, that is okay. I think some of the questions are there related to this SGB. So one person has asked whether this 2.5% interest is on the current market price or the invested amount. So that is on the investment amount only. 2.5% is on the face value that will say that is on the face value will be there. And some of the questions are there where you can buy these SGB. The SGBs you can directly, if you are first time investing into the SGB, whenever the RBI will come with an option, you can directly apply from your e-banking also, internet banking also, or the RBI retail direct also, or from your demat also. And in the secondary market, it is tradable on NSE platform, so you can directly buy from the demat also. These are the part. Yes, the fluctuations and the price volatility will be there on the SGB. It is listed, so fluctuations are there. So these are certain price, sir, 5 or 3 years, which is correct. So Ashutosh, I don't getting your question, 5 or 3 years, but yes. Other things.
We'll move on. We'll
Yes.
move on to the next slide.
Yes,
Maybe you
yes.
want to take this equity up, or
Yes.
I continue?
So I can also take, or otherwise.
Please go ahead, sir.
Yes, so equity, again, one of the class of investment is there where as compared to the bonds or the fixed income security, the equity will give you an idea to you, an ownership to you, ownership of the company. So when you become an owner of any company, definitely you have to share the profit as well as the loss also. So that is the biggest challenge as a part of the equity shareholder is there. Definitely it will provide higher return, as we'll see in the first slide also as a part of the graph, with the higher return as compared to the other asset classes, but risk is higher as compared to the fixed income security. And as a small investment or automated investment process, you can do investment in equity by purchasing one share also, by purchasing the bulk share also. You can do the small investments also. But when you invest into the equity, you have to make sure that you have to understand the nature of the company, nature of the business before investing into the equity, because the risk is associated high as compared to the fixed income security or the bonds in the as compared to the equity. Sunny, can we go to the next? Yes. So again, bonds and the equity both are regulated by SEBI. So that come under the regulatory parameter of SEBI. One is the fixed income security, one will come under to the equity. The returns on the bonds are fixed and relatively lower risk. There is no fixed return on the equity. Some of the companies do provide the dividend to you. The frequency of dividends can be there, but dividend is not compulsory. Dividend can be provided, dividend cannot be provided. And yes, the risk is very high because this prices of this equity is totally linked with the market demand and supply sentiments of the persons, those who are investing into the market, global market things are there. So all the things are risk is there. Safety, so repayment of the principal is compulsory by the borrower, but there is no obligation to repay the principal by any company to you. If the company become defaulter, all the equity amount can go down. The company, if the shares are delisted, then yes, that there can be the risk of the liquidity will be there. So there is no safety of the principal amount that you made into the bond. Now, again, the cash flow. So, yes, there is a simple cash flow that we discussed in the previous slide also. When you invest into the fixed income security, the frequency of the cash flow will be there either in the monthly, quarterly, half yearly, or the annual year will be there. And in the cash flow as a part of the equity, that is subject to subject vary. Sometimes company can declare a dividend, sometimes company cannot declare a dividend. When they are going to declare dividend, that you don't know. That depending upon the investment policies of a company or the capital structure of a company, that can be affected. Risk associated with the fixed income security is the 1 year risk is the interest rate risk, and the returns are not affected by the volatility in the market. That these are the risks there. So when we'll say about the interest rate risk is that whenever the Reserve Bank of India or the central government change the interest rate, it will affect the yield. It will affect the yield of your fixed income security, because that is the interest rate change, the price and yield of the fixed income security will be there. But yes, as compared to the equity, the market risk is there. The market can be totally based on the sentiments, totally based on the demand and supply. There can be the geopolitical risk is also there. So it is very volatile and high risk is there. But at the time of bankruptcy or the liquidity, the first priority will be given to the bond holder or the fixed income security holder. The last priority will be given to the equity if something is remaining with the company to repay to the equity shareholder. And again, one more part, let's take an example. If you purchase any share today into the market at 5,000 rupees and the face value is 1 lakh rupees and the company become defaulter, if the company is going to give you money back at the time of default, if something remaining with there, only the face value will be given to you. That is 1 rupees only. That you have to remember on that part. Liquidity, as Saniji also discussed, that liquidity of a bond is low to high. Some point of time moderate liquidity is there. There can be multiple factors depending upon the rating of a bond, depending upon the demand and supply, depending upon the investment size of a bond, that can be there. But yes, equity is a high liquidity because the one can trade on the equity on any platform, and the more demand and supply will be done as a compared to the fixed income security, the equity is there. But equity is consist of the risk higher as compared to the fixed income security. Both are regulated, and both the markets are depending upon the, again, when you will say when I should invest into the equity, when I invest into the bond. So best part is that the younger age you have, the longer duration, if you want to do the investment, equity is one of the good option to take a higher risk over the period of time. But the fixed income security, if you are as a part of the what I can say, into the part of the verge of the retirement, the risk appetite is lower. In that case, you should invest into the fixed income security over here. Sanij, anything you want to add on this part?
No, I think it's perfectly covered. I am in sync with what you right now said. There's nothing more to add to this, sir. Just moving on to the next slide. Some of you have asked in terms of what is the investment returns that you can expect. These are not exact rates. These are just range bounds, indicatives. Government securities are trading currently at 6.75 or even lower in that range, which is probably the lowest risk attached, called the risk-free return. Then you can expect a AAA, LIC or a REC to give you a return from a 7 to 8%. A little lower rated bond, which is a AA rated, can give you a return anywhere between 8% to a 10% bond. Going back, a little higher return if you're expecting, then a small finance bank bond issuance or a Spandana Spurti can give you like a 10 to 11.5 to 12% kind of a return. Anything, if you go lower, if you see the graph on the presentation, the risk reward is automatically changing. The higher you go in terms of your risk, your return starts going up, the liquidity also starts coming down relatively. So depending on the asset class that you invest, depending on the credit rating that you invest, the liquidity and the return changes, right? Over to you, Kapilji, for the risks attached while investing in any bond.
So I think we have covered almost all the risk while discussing the previous slides. But yes, in
Right.
quickly, when we invest into the risk, bonds or the fixed income securities, the first risk is the liquidity risk can be there. This risk is a part when you are investing to the fixed income security. If bond is a junk bond or the lower rated bond, at that point of time, liquidity can be one of the biggest challenge for the investor is a part. And why the liquidity is the biggest challenge? Because you don't know how to trade the bond into the secondary market. For this, if you trade the bond into secondary market, the liquidity risk can reduce. That is one of the part. Number two risk is the market risk. So market risk is the interest rate risk can be there, or it can be the risk of the geopolitical risk, or it can be the risk of the some sentiments related to the government or something like that. The market risk is there into the bonds or fixed income security. If suddenly the Reserve Bank of India changes the rates or the reduces the rates, the best example of the market risk, even I think we have discussed in the previous session also, that when this Fed has reduced the suddenly increased the interest rates into the market, the Silicon Valley Bank collapsed due to this interest rate risk into the US market. So these are the examples where it affects the yield, basically yield and price of a bond. That is a market risk is there. There can be the credit risk into the bond. If suddenly credit rating agencies reduce the credit rating of AAA rated bond to BBB minus or double B, and that point of time, there is a risk of the reduce of the price of a bond into the market. So that risk is there. And the fraud risk can be there if you are trading on the bond on the illegal platform. Of bond is insecure, you don't know whether the bond is right or wrong. If it is not regulated, then in that case the fraud risk can be done. But yes, this risk when you are investing to the bond market or the fixed income security market, these are the major risks that you have to consider before investing into the bond. Any other risks, Saniji, you want to
So,
discuss?
sir, I think these are some of the risks, and some of you have asked questions. Credit risk. There are AAA bonds which have gone through difficult times, DHFL or INFS. It does not mean that all AAA or everybody is safe. It's a SEBI-regulated third-party entity, CRISIL, ICRA, CARE, Acute, who give these ratings. They give a third-party opinion based on the credit assessment. There can be some cash flow mismatches, which is what is called a credit risk. I think that is pretty much it. Just before we move on to the last, we are almost towards the end of the presentation. Just want to launch a small poll just to understand why historically, if you have invested, not invested, what is the reason why historically you are not able to invest in bonds? In case if you've never, if you have, then you can skip this question. However, if you have not invested, then what was the reason? Is it because of limited access, low returns, no liquidity, or actually the fourth answer that I have not added, I should have added, my bad, is that we don't have the information or the knowledge when it comes to bonds. Lack of understanding of the asset class, basically. Maybe my bad, I should have added that as an answer also to this question. And some of you would have probably opted for that as well. So apologies for that, audience. But I think limited access to bonds, low returns, or no liquidity or no exit options is what is the three options that we've given. We are trying our level best, Kapilji, myself, NISM support, IndiaBonds support, wherein we are trying to educate our audience. Okay, what is the reason that you have not invested in bonds? We'll just go on for another 10 seconds. I request everybody to please participate. We have 63% participation. There are more people participating. Okay, that's increasing now. Why haven't you invested in bonds historically? Guys, please, I request all of you all to do answer. Plus, we are going to do the next set of next webinar soon, next month, early next month. There we'll be explaining the important factors that you need to see before investing in a bond. What are the key factors that you should see before investing in a bond? What are the key important documents that you should be investing? What is the risk attached to it? And how you could buy a bond as well. Because a lot of you are saying related to this question, Okay, now we have almost 80% participation. I'll just read out. I'll just end the poll. 58% of the people, Kapilji, are saying that limited access to bonds. That means people are not aware, they are not giving accessibility. Second reason is low returns, which is 26%. And 15% of the people are saying no liquidity or no exit options. So we'll try to burst all these myths probably in the next webinar, which is going to be early in October, wherein we will be covering this on 11th October. We will shoot out another mail and registration links also soon for that, along with NISM. But yes, we get this as an option. Thank you so much, everybody. We'll move on to the Q&A section, sir. We have a lot of queries that have come up. Should I start reading out, sir?
So yes, so can we start from the first question or
Yes, sir.
Yes,
Yes, sir.
yes. So first question was there. I think I want to know about the liquidity. I don't think we can close or sell the bonds whenever I like, similar to the share. How much it is traded happen usually? So liquidity question is there.
Right. So, Garlapati ji, you're absolutely right. Bonds are somewhere where probably equity was 10 years back. Bonds is on the same path. There is liquidity in bonds that you invest. Highest liquidity you will see in GSEC or a AAA bond. I would request whenever you want to look at a very high liquid asset, then try and go in for something which is very, very liquid, only in terms of when the credit rating risk is low. So my request will be try and look at that aspect. Maybe that will help you. And we are trying as an online bond platform also to support our investors to increase liquidity. Exchanges are supporting us. All of our trades are going through RFQ mechanism. So we are trying our level best to add to this and improve. Hopefully in the next 2-3 years time, you'll see the liquidity to go up. However, in case if somebody, we do assist on best effort basis while anybody who wants to sell a bond, right? Okay, Kapil, next question.
Some of the question related to the yield is there. So what is the difference between yield and a coupon? So simple answer is this: coupon rate is mentioned when the bond is issued into the market. That is through the face value. So every year the cash flow will be provided by the company to you. That is the yield. That is a coupon. Whereas the yield is the, in simple terms, it is a real rate or the internal rate of return, where whatever cash outflow you have made and whatever the cash inflow is there, at which rate you are getting the return. So yield can vary over the period of time, that depending upon the market price or the maturity price of a bond, whereas the coupon will be same. If the bond is issued at 10% coupon, the 10% coupon will be same for you, but yield can vary. It can be higher than 10%, it can be lower than 10%. If yield is higher than 10%, in that case, the bond will trade on discount in the market. It means the selling price of the bond in the secondary market is less than the face value. But if the yield is lesser than the coupon, in that case, the bond will sell at the premium into the market. So the selling price will be higher as compared to the face value. So this is a basic difference between the yield and the coupon. Is there anything, Sunny, you want to?
No, that's absolutely correct, sir.
Another question is there how bonds are different from the debentures. So yes, bonds and debentures, earlier we have answered this question also. Bonds are issued generally by the government or government institutions, where the debentures or NCDs are issued by the private companies.
Correct.
Hmm.
Next question is by Mr. Anand Tripura.
Hmm.
Says bond investment will be based on tenure for which it can be held. So, frankly, sir, we've not got your question. Maybe if you want to post your question again, we'll try to take that up. Next is Kailash. Sir, if you want to take this, why does vice versa movement happen in price and yield? If I invested in GSEC or bond, why yield is changing?
So that I answered already, that depending upon the
Correct.
maturity or the volatility, the yield will change based on the market price will be there.
Correct. So, like Kapilji said, sir, if you buy a bond of 100 rupees, you are getting 10 rupees interest if it's at 10% per annum. Now, if the same bond, if you sell at 101 rupee and the new investor who's coming on board, he will still continue to get only 10 rupees as interest. So he's actually bought at 101 rupee, then and he's getting a return of only 10 rupees. So his yield has gone down, but the price at which you have sold is gone up. That is how it works. Rajiv Sharma says, what are the top 5 parameters to be checked while selecting a bond? Sir, I don't know the top 5, but I would definitely tell you one thing is that please ensure that you go through the information memorandum, that is your Bible. Ensure that you invest in, if you invest in bonds, then you please invest in a regulated instrument which is listed. Try and ensure that they are rated also, and try and invest in, depending on a risk reward, choose the bond based on that, and do speak to your advisor. If you have a RIA, then speak to him. If you have a broker whom you invest through, you can speak to him. And you should evaluate multiple options and then look at investing. And always remember, every asset class has some risk attached to it. Anything, Kapil sir, that you want to add?
Yeah, that is fairly.
Okay. Next question is Urmilesh Kumar. What the panel is expecting with reference to cut in interest rates by Federal Reserve? I expect more FDI in Indian market. RBI may cut interest rates as well. What are the other expectations?
So again, that depending upon the policy of the government, the Fed cuts the rate, that doesn't necessarily the Indian market also government can also cut the rate. That can be the part. But yes, macroeconomical side, if Sunny ji want to add on this question.
Like Kapilji said, yes, the overall market feels that there can be a rate cut. However, nobody can really assure, depending on the macroeconomic condition of the Indian economy. We are influenced by international markets, especially US. However, we are not over dependent or highly dependent on these markets. But yes, depending on whatever the finance ministry or RBI thinks, if it is required and if inflation is under control, then maybe we are moving towards a rate cut regime. But for when, how long, we don't know, because the industry experts, I'm not a fund manager, neither am an economist to really suggest on this. But yes, the industry experts were always expecting a rate cut for the last 1 year. Unfortunately, they have all been proven wrong. So very difficult for us to genuinely give our comments. But yes, the market feeler and the market rumor says that in the near future there can be rate cuts. So yes, I think that also answers to the question with reference to debt funds. Anilji has asked, so I hope that answers your question also. So we able to answer 2 questions. Next question, Mr. Rajiv Sharma. What is the meaning of secured bonds? How are bonds secured?
So, Sunny, you can answer this.
Yes. So, Rajiv, every bond can be secured or unsecured. You should always check whether it is a secured bond or an unsecured. In case of secured bonds, they normally, an NBFC would give you the underlying assets. In their case, these are loans that they give ahead. So, the cash flow that comes from these loans, which they have given ahead, or if a company has, if it's a manufacturing company, maybe he's given his plant and machinery as security or any other fixed asset, that can be a security. Normally, all secured bonds will have a security cover also, which probably in the next presentation when we'll be covering, we'll try to cover that also, and we'll show you a draft deal sheet or a term sheet also of a live or a already issued bond as well. So I would request stick around for probably the next webinar on 11th October, and we'll try to answer this question more in detail and give you more detailed inputs on the same. Next question is, sir, premature withdrawal allowed up to a certain limit without any penalty, by Ashutosh ji.
So that was, I think, FD side, that question was there.
Yeah.
Yes.
Maybe, yes. So in FD, yes, premature withdrawal, the same way like Kapil sir had said, that bonds are also listed. There is no penalty, but it can be lead to capital gain, capital loss, depending on the bond in which you have invested. Next question is, what are tax-free bonds? So tax-free bonds are, it's anonymous attendee, so we don't know the name. Tax-free bonds are bonds which were issued by some of the government-related entities like RECs, PFCs of the world. They had issued some tax-free bonds which are available probably in the secondary market, which you could look at investing. The interest income that you earn on these tax-free bonds are completely tax exempted. And your principal is just your principal coming back, so they'll not be. But here you can expect a lower return anywhere between 5.5%, anything between that. It depends on the market volatility and the demand, right? Okay. Next question. Pranav Singh ji saying, sir, is it necessary to hold bonds in my portfolio?
So yes, when the diversification you are looking, then it is necessary.
Correct. So it's a diversification strategy, not concentrating on any single asset class. Depending on where do you stand in your life cycle, you should try and explore that as an asset class. Sometimes it may fit in your requirement, sometimes it may not, depending on the risk reward ratio that you are willing to take. Right? Pulkit Gupta ji, is 10% TDS applicable on long term and short term exits?
So exist the 10% TDS is on the coupon, I think, if the
That
company.
is correct. On interest payment, 10% TDS is applicable, sir. Long term and short term is the capital gain, Pulkit ji, that you look at investing. Any interest payment by listed bonds will be 10%. TDS will be deducted on the same. However, you have the option in case if you don't come under the tax bracket, just like FDs, there's a 15G, 15H form that is available, which you need to reach out to the issuer, share your 15G, 15H, and no TDS will be deducted in that case, provided you form under that category. You fulfill that requirement of that category, rather, I would say.
And again, if you not fill the form and it is deducted, there is a chance that you can file the ITR and you can claim the tax back on this part. TDS.
Sharmaji, we've covered tax-free bonds. Who are selling these bonds by Mr. Uma Shankar? Is it RBI? It is not RBI. Government securities are issued by Government of India. RBI, you can buy through RBI Retail Direct, or you can buy through any of the online bond platforms, wherein you can buy a demat form also from the online bond platform without opening an SGL account. And other than that, REC, PFC, NHAI, these or any other entities like L&T, Tata, Birlas of the worlds, they issue these bonds, sir.
If we see any major question, then
when you say bonds, you are including debentures, right? Yes, sir. Bonds and debentures, we are referring to both, just to let you know. I'm just going through some of the questions.
some question is related to brokerage and commission charge while buying the bonds.
So as an online bond platform, sir, we do not charge any commission or brokerage to our buyers. So yeah, I hope that answers your question. Property price appreciation is to be considered as investment group opportunity. Ajay ji, correct, in the calculation that we've given, it's from the RBI housing index. So it is considered from property price appreciation itself from that angle as well, the slide that you saw. Next question is, RBI bank bonds are same? If no, please share difference. Gitanshu ji. Kapil ji, would you want to take that up?
So RBI bank bonds are the bonds which are issued by the banks. That is the scheduled banks into the market. They are listed and come under the purview of SEBI. Where whenever the RBI is coming with an issue, so there the government or GSEC is there, so they are come under the purview of RBI. This is a one difference. And the GSEC is lesser, what I can say, riskier as compared to the bank bonds. That is one of the part. And these bank bonds are listed on the platform or traded on the platform of NSE and BSE, whereas this GSEC will be traded on NDSM platform.
Okay. Some of you are saying that the presentation or the recording that of this webinar, will that be available? Yes, that will be available on the YouTube channel, and it will be available for all. Post the webinar within 2-3 days. We normally upload that on our website as well as in the webinar, plus the Bond University as well. And maybe NISM will also host it on their YouTube channel in case if they want to. That's
some of the questions that we were discussing before the presentation related to SGB. It is discontinued, whether it will be back and something like that.
Sir, unfortunately, there is no official announcement whether it is discontinued. As of now, it's been quite some time. We have not seen a primary issuance that has come out. So it will be a little difficult for us to right now comment, because we are not representing Government of India, or we don't frankly know that whether when they are going to come up with. So thank you so much, sir. I think Siddharth ji is appreciating our slides, Kapil ji, that we've done. It's in detail. We tried our level best.
I think most of the questions we answered. If anything is there,
I'm just going through some questions. So private companies, what is the maximum? What is the maximum limit of investing in an SGB gold bond for an individual in the primary segment was 4 kgs, sir.
4 kg.
Vinitji, you've raised a question. I have too bad experience in DHA financially. I am now hesitant to invest in NCDs. You're absolutely right. It's history, and that has happened. We cannot change that. But yes, try and speak to your financial advisor to ensure that you invest in as safe as bonds go through their balance sheet. Whenever, let's put it this way, when you invest in equity, you lose your capital also sometimes, right? HDFC Bank would probably be at 1600 one time, can be at 1500 as well. So there's a possibility there also. But we have to study the fundamentals, try and understand, go through the information memorandum, go through the rating rationale, try and do a little bit of research on the company or speak to a financial expert who can advise you whenever you're looking at investing in a bond.
So one question was there, if an investor is investing in the company shares, one company share and the same company bond also, who will give the priority if company become defaulter? So definitely the bondholder will have a priority to get money back. Equity will the last option if available with the company only.
Correct. In terms of priority, equity holders will be paid later. Secured bondholders will be paid for, prior to that. Okay, I think, sir, do we get the participant certification? Yes, you will get it. Anybody who's attended this webinar for majority of the time will be getting that as a participation certificate. It will come directly from NISM to anybody who's attended this webinar. Neeraj, I hope that answers your question. I have physical. Somebody's asked, is DMAT necessary for SGB? Sir, to the best of my knowledge, if you want to invest in the online SGB, yes, DMAT is compulsory. Or if you want to buy in the
Then
secondary bond as well, it is compulsory to have DMAT account. Right. I think, sir, we have already overshot the time by 20 minutes. Do you want to take 1-2 more queries, sir, before we
so
end?
any query which is unique, then we can discuss. Or Amirji, if you notice any questions that we should answer or we forgot.
Sir, more or less all the questions and the queries has been covered togetherly. So all the questions are covered till date.
Someone was asking, sir, please take my question. I think was that.
His name is
My query is about the
SFP.
SFB.
I think SGB,
That
maybe
is SGBs.
SGB would have referred. Can you, if you want, please repost it. We'll take it up, sir. Some are asking, can we invest in bonds for wealth creation for long term? Sir, depending on which bonds you invest, that can help you depending on your risk reward ratio that you're looking at investing. It can definitely help you. Are bonds safer during market crash? Sir, equity and debt are not very highly correlated. They are inversely related. If equity markets do correct, people do move towards more safer havens, towards gold, towards bonds in terms of going into more AAA or government securities. So yes, that is inversely related to each other.
So one question is there, why to invest in bond, not in equity, while both are subject to market volatility?
Sorry, can you repeat that,
So
Kapil?
why to invest in bond, not in equity? Both are subject to market volatility.
That is correct, sir. But the fluctuation, to answer to your question, of fluctuation in equity in terms of price fluctuation is relatively higher. You should invest in whichever asset class that suits or fits into your risk reward ratio. No, any specific asset class is good or bad. For somebody who is probably a little more aged, wants more stable fixed return, market volatility in bonds is only considered when you are trading into it. If you're holding to maturity, then and if the credit quality is good, then there is no market fluctuation, you will get your principal money back. So there is no risk that you will run in that. Unless until you are a trader, then only you run that risk. In equity, you either ways run that risk.
I think we covered almost all the questions.
Yes. So people who are asking the certificate within a very short point of time, you will get a certificate directly from NISM, Anthony ji. So don't worry about it. It will come to you, right? Okay. Thank you so much, audience. Thank you everybody for this session. Thank you, Kapil ji. Over to you.
Thank you. Yes.
Over to you, ma'am.
Good evening, everyone. Thank you all for attending today's webinar on bonds versus other asset classes. Special thanks to our expert speakers, Dr. Kapil Shrimal and Mr. Sunny Mirchandani, for your valuable insights into the bond market, excellent comparison of bonds with other asset classes. Your perspectives were truly enlightening. Thanks to our participants for your engagement and thoughtful questions. We hope you found the session informative and useful. Wishing everyone a great day ahead. Thank you.
Thank you so much.
Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.